share with you the second part. Uh, it's an interesting topic with reference to the dividend, because nowadays it's very common that common people are investing in some different types of stocks, and especially those small investors are not there for doing intraday trading. They are there for investment, and they are looking for a dividends and dividend payouts. So dividends and dividend policy part two, that's alternative to a paying a dividend. What are the possible alternatives that we can use in instead of paying dividend out? Select additional capital budgeting projects, so we can increase the business by installing more uh, uh, production facilities, or any type of capital budget that can increase the capacity of the business to earn. Repurchase shares from the market. So by this way, what is going to happen? The total number of outstanding shares will go down. Or acquire other companies, and they can acquire other companies, and they can merge other companies, small companies into them, so that they can business their market share is going to increase, and by this way, there's going to be beneficial for the investors in the long run. Repurchase financial assets. They can also buy the bonds or the stocks of other firms, so that they can make profit on, or they can get returns on it. So these are the things that the firms can, or the corporations can do, instead of distributing the profit to the bondholders in the shape of a dividend. So what are the possible alternatives that the corporations can do as in place of paying out dividends? Now, high payout, please. That is also a request from small investors. So why might a high payout be desirable? A desire for current income. So small investors, they want to get current income increase, and that's they are demanding, or their desire is that the dividend should be high. Indwell in low tax brackets, they prefer that high payouts. Uncertainty resolution, no guarantee that the higher future dividends will materialize. So that we are short-sighted, and we want to get what is the maximum in present situation as compared to in future what is going to happen. We don't know exactly. So that's an uncertainty. That the taxes, dividend exclusion from for corporations, and tax-exempt investors do not worry about different treatments between dividends and capital gains. So these are the those who are looking for a high payout. So we just discussed that those who are looking for a low payout is large investors with a high income brackets in tax, and there for a high payout is for those who are in a low income bracket, and those who are looking for a current income increase as compared to the future, and those who are uncertain about the future. What the dividends in the market do, like they give signals. If you are paying good dividends, so one signal is that the firm is earning good profit. So it means that this firm stocks has a value. But there is another signal that if they are paying out the dividends, so it means that the retained earnings are less, and the value of the stocks will drop down exactly equal to the dividend paid. Dividend and signals asymmetric information. Managers have more information about the health of the company than investors. We all know that the managers are insiders, and that's the reason that insider trading is not allowed, because they all have a more information as compared to a general investor. So change in dividend convey information, and dividend increases. Management believe higher dividend can be sustained, and expectations of higher future dividends increase present value, and signal of a healthy growing firm. So all these are the signals, and management believes higher dividend can be sustained. That's why they give a signal as a dividend, and expectation of a higher future dividends increase present value, because the present value of a stock is dependent on expected future dividends. Dividend decreases. Management believe it can no longer sustain the current level of dividend, and expectation of lower dividends indefinitely decrease the present value, and signal of a firm that is having a financial difficulties. So no dividend or increased dividend or decreased dividend or more dividend. So these are some signaling with the dividend into the stock market. The stock market is getting signals if there is a increase in dividend. The stock market is also getting signals if there is a decrease in dividend. So clientele effect. Some investors prefer low dividend payouts and will buy stocks in those companies that offer low dividend payouts. And some investor prefers high dividend payouts. And we just discussed that low payout, please, or high payout, please. And the reasons we already discussed that why the investor is interested for low payouts and high payouts. High payout and will buy stocks in those companies that offer high payout dividends. So investor will self-select into the stocks have their preferred payouts policy. So managers should focus on a capital budgeting decision and ignore investor preferences. So managers are not worried about what the expectation is because they are making their choices according to their policy. So implication of the clientele effect is what do we think will happen if a firm change its policy from a high payout to a low payout? Definitely the signals is going to be different if we are a high payout firm or a corporation to converting our policy to low payout. So what do you think will happen if a firm changes policy from a low payout to high payout? So the investors' preferences is we already discussed that some investors are high payout preferred and preference, and some investors have a low payout preference. So in that case, what is going to happen? That we gonna change the signals for those, and that's why if this is the case, does dividend policy matters in that scenario? And as we mentioned in our previous slide as well, the managers are focused on capital budgeting. They are not taking care of that why the customer investors are moving out and new investors are coming in because of their preferences. So it doesn't matter. Now, this is a general information about TSX, like Toronto Stock Exchange companies, and their dividend yield from January 2015. Why this data is old? Because the book is reflecting those data. You can look at this data from the Toronto Stock Exchange website as well. Like Royal Bank of Canada dividend yield 3.9%, which is quite high. Toronto Dominion Bank, Bank of Nova Scotia. So we see that the top the top dividend paying companies in this is mostly the banks or the financial institutions, right? There are some pharmaceutical as well as natural resources companies there as well. But we see that uh, Energy, Husk Energy, Trans Canada Corporation, Manulife. So we see these are the payouts or dividend yields percentages. Residual dividend policy, determine capital budget. Now, whatever paid out, the remaining retained earning is retained in the business as a retained earning, and this retained earning can be used for capital budgeting. Determine target capital structure that can also change their debt to equity ratio. Finance investment with the combination of debt and equity in line with the target capital structure. Remember that retained earnings are equity, and in additional equity is needed issue new shares. So if we need more equity, we can issue the shares as well, but retained earning is also a part of an equity. So as we keep more and more retained earning in the business, it means the equity portion of the debt structure is going to increase. So if there are excess earnings, they pay the remainder out in dividend. So here is an example like for a residual dividend policy, the firm needs 5 million for new investment. The target capital structure debt to equity ratio is 2/3. Net income for the firm is 4 million. So they need 5 million and their net income is 4 million. Point dividend, 40% financed with debt and 60% financed with equity. Now, You see here how much we need, 5 million. How much is the income available? 4 million. The debt to equity ratio is 2/3. Now we want to find out how much we have to distribute as a dividend if our policy is that we want to keep the debt to equity ratio as uh, financed with debt, this 5 million financed with debt, like a 2 million with the debt and 3 million with the equity. Now, net income minus equity financing is 4 minus 3, so 1 million paid out as a dividend. So we see here that this corporation has an income of 4 million. They need a capital. They need a capital or finance to start a new project. Now, for that project, they need a 5 million and the income is 4 million. So the policy is that we want to maintain the debt to equity ratio. So in order to keep the debt to equity ratio the same, we need to get 2 million as a debt and 3 million as an equity. So out of 4 million, we use 3 million for this project, and the rest is 1 million, which we can pay out as a dividend. Compromise dividend policy, like goals ranked in order of importance, and avoid cutting back on a positive NPV projects to pay a dividend. So that's a main objective, that if we have a project in hand in which we have a positive net present value NPV, then the project should be good as compared to paying out some dividends. So avoid dividend cuts, avoid the needs to sell equity, maintain a target debt equity ratio, maintain a target dividend payout. So these are the priorities or preferences for the management of the corporation or a firm. That can be different sequence, but mainly the companies want to accept a positive NP project while avoiding negative signals. So factors influencing dividend policies, stability of earning, moderate or high level of importance, pattern of past dividends. That's also very important for manager to keep it in mind. Why? Because of they don't want to give a negative signal. Uh, Level of current earning, that is also important, that if you are paying a dividend from the current earning or from the previous earnings, and desire to pay out in the long run a fraction of earnings. So that's a way that we can, those are the factors that influence the dividend policy of a corporation. Manager's opinion on dividend policy. These are the factors that affect the decision, because the management of the firm first evaluate and then present a proposal to the board of directors that how much dividend they should pay out of the earnings. So what are the policy statements the managers can make? A firm should avoid increasing its regular dividend if it expects to reverse the dividend decision in the year or so. So that's the person who agrees or strongly agrees that we should not increase current year. If we have a more profit, we should not increase is the dividend if it is not possible to continue this for in the future year. So that's a very important, because if this year you pay, that has a positive impact, but next year if you decrease the dividend from the current year, in that case that has a negative signal for the firm. A firm should strive to maintain an uninterrupted record of dividend payment. So the firm should be consistent on their dividend payment policy. They are not increasing or decreasing very rapidly or very frequently their dividends, because that gonna give, we already discussed many in our slides, that that's going to give us a wrong signal to the market. Investors generally regard dividend changes as a signal about a firm's future prospects. The same point which I explained. A firm should change dividend based on sustainable shift in earning. A firm should adequately disclose to investors its reason for changing its cash dividend. So if in any case, if we want to change our cash dividend policy or a cash dividend payment, then we have to disclose it very clearly, the reasons, the causes, or the objectives behind this change in our policy. Then comes that in place, as we discussed so far, what we discussed is about the cash dividend. But there is another way that we can give a dividend is a stock repurchase, and by this way the value of the stocks increase. So companies buy back its own shares of stock and tender offer a company states a purchase price and desired number of shares. So open market buyback. So one is that they call a tender from the investors. Okay, we want to buy your shares on this price, which is normally more than the market price. And by this way, the stockholders say, okay, we if the price is higher than the market price, so it means that the difference is their dividend what they are getting. They can also do it open from the market, like as a general buy stocks in the open market, and that is going to be purchased on the market price. Similar to cash dividend in that it returns cash from the firm to the stockholders. And this is another argument for dividend policy irrelevance in the absence of a taxes or other imperfection. So that's another way that we can pay some cash to the investors in shape of buying the stocks from the cash. That has a double impact. One is that the investor is getting cash. On the other hand, there is as the number of outstanding shares decreasing, so the per value of the per stock value of the or per share value of the if we calculate for the firm is going to increase because the number of outstanding shares going to reduce. Stock repurchase allow investors to decide if they want to current cash flow or associated tax consequences. The Income Tax Act requires investor to report a deemed dividend equal to the excess of the amount repurchased over book value. So that is going to be considered as for a tax purposes, that is considered to be as a dividend when a firm is buying the stocks at a higher than the market price. So report a deemed dividend equal to the excess of the amount repurchased over book value. So this removes the tax advantage of stock repurchase over dividend. So as they treat this difference of price as a dividend by the tax authorities. So it means that there is no tax benefit whether the firm is going to declare the dividend or pay the dividend or they repurchase the stocks. Stock repurchase sends a positive signal that management believes that the current price is low, and tender offers send a more positive signal than open market repurchase because the company is starting a specific price, and the stock price often increases when repurchases are announced. So that's the way. When the dividend is declared, the stock price go down, but when the stock repurchase is happening, the stock prices go up.
Professor,
Simran, you want to say something? Yeah, because your mic is now on.
yeah, Professor, can you explain tender offers?
The third option we not so far we discuss is a stock dividend. Pay additional shares of stock instead of cash. Increase the number of stocks, a number of outstanding shares that if we give them a stock dividend, then what is going to happen is increase the number of outstanding. So repurchase, reduce the number of outstanding shares, but if we give them as stock as a dividend, then it is happening that they increase the number of outstanding shares. So if you own 100 shares and the company declares a 10% stock dividend, you would receive an additional 10 shares. That's a stock dividend payment, how the stock dividends are paid. Uh, Reverse to or opposite to our stock dividend is a stock split. That how we can increase the number of stocks. But the value is not going to impact so much because if one stock is of $100 and when we split it to two, for example, we did split it into two, so each stock is going to be of a 50 value. That's the way. So stock split essentially the same as the stock dividend, except expressed as a ratio. For example, a 2-for-1 stock split is the same as 100 stocks dividend. Stock price is reduced when the stock splits. Common explanation of split is to return price to a more desirable trading range. And sometimes it happens that if the price of the stocks are so high and they are not considered to be a very actively traded in the business because the single stock is so high value that the investors while trading is considering that we are dealing in a very low numbers of shares. So for that reason, they split it and reduce their value up to this. Like for example, if a stock is of a 400 and they split it into 1 into 4, so what is going to happen that each stock is going to be, now there is a 4 instead of one stock. So by this way, the value of the stocks is reduced to 100. So it's become more tradable. You know that the cheaper the value is, the more tradable it is. So this is all what I want to discuss from the this chapter. Now, what I designed for today is that we go over a certain questions from this chapter, that how we can tackle those questions if we see related to the stock dividends or cash dividends or all these types of things. So I share with you the question and then I solve it with you on this while explaining that what is the how we can tackle those questions. So let's stop sharing this slide. And so I named these as a practice questions from this chapter, dividends and dividend policy. Let's talk for our first question. And I want to make it bigger. So Pandose Corporation has declared a $4.80 per share dividend. Suppose capital gains are not taxed, but individuals are taxed at 15%. Pandose sells for 68.20 per share, and the stock is about to go ex dividend. What do you think ex dividend price will be? So ex dividend price will be, how do we calculate, and explain you in the beginning that the ex dividend price is going to be exactly reduced by the dividend amount. But keep it in mind, there is a tax implication here, and we have to reduce this price according to the tax implication, and then we have to adjust the price. So how we can do this, the next slide I keep it blank. The reason is that I want to solve it there. So first of all, what we have to do is we have to find out the after tax dividend. And how do we can find out after tax dividend is 4.80 is our tax, dividend, and the tax rate is 0.15%, right? So after tax, the dividend is 4.08, right? This is our dividend per share. So if we want to find out the ex dividend price, so what is the price before? And this is the price 68.20, and then we have to subtract the after tax dividend, which is 4.08. So the price of this stock at ex dividend date is going to be 64.12. So what we learn from this question is that if there is a dividend and also there is a tax implication, like a personal income tax, you have to pay whatever the dividend you are going to pay. And in this question, it is given like a 15%. So we have to adjust the dividend with the tax rate, and then we subtract that value from the market value of the stocks before ex dividend date, and on the ex dividend date it's going to be reduced by the amount of the tax. So I hope you understand this idea or a concept. Now this question is also interesting in the way that how this stocks. So Mill Creek Corporation currently has 425,000 shares of stock. So these are the number of stocks outstanding that sell for $80, and this is the market price for. Assuming no market imperfection, no tax effect exists, what will be the share price? Share price will be after. What will be the share price after? So it's a typo. It's written two times. Will be after, and these are four different scenarios are given in the sense that what is going to happen after each scenario. The first scenario is saying that MCC, this is name of the corporation, Mill Greek Corporation, has a 5-for-3 stock split. Now 5-for-3 stock split, I take it to the next, and this is our A part. How much right now? We have 450, right? What we have to find it out? Share price, right? Share price. Share price will be so right now. What is the share price? 80. And how much is the split? What we are discussing? The split is 5-for-3. So we multiply it with the 3 and divide it with the 5, because we are getting 5 in place of 3 stocks, so it's going to increase. So we multiply with the 3 and divide by the 5, so that is going to give us the value of the stock after this split of 5 by 3. So 20, so we can divide it and we can get it $48. So after this split, the stock price is going to be $48. What is the next scenario is MCC has a 15% stock dividend. So if they give a 15% stock dividend, what is going to happen is 1 over 1.15 is going to be 69.56. That is going to be the value of the stock after announcing or after payment of a 15% stock dividend. 15% stock dividend. Scenario 3 here is MCC has a 42.5 percent stock dividend. So now they are going to give how much stock dividend is 42.5. So it's a huge amount of stock dividend, and we can see it here, 80 into 1 over 1.425, and by this way the value is reduced to 56.14. And the D part is saying the MCC has a 4-for-7 reverse split. Reverse split means that we didn't discuss in the PowerPoints of this topic, but reverse split is just an opposite of a split. Like we divide the one stock into two. There is a possibility that we can combine 2 into 1. That's what we call it as a reverse split. Now reverse split is going to increase the value of the stock because we are decreasing the number of outstanding shares, right? So we are decreasing the number of outstanding shares. Now how we are doing it? 7, we are issuing 4 to 7. So we multiply it with the 7 and divide it with the 4. Just opposite to the first scenario. So we 80 into 7 and divided by 4. So we see here the value is going to be $140. So reverse split is going to increase the value of the stock. Why? Because now those who have 7 stocks, now they have 4 stocks, because that's a reverse split. So you see that what is an impact of these stock dividends or stock split or reverse split. Now the third question is Rutland Corporation has declared an annual dividend of 50 cents per share for the year just ended, earning $8 per share. Now, what is the Rootland's payout ratio? So we want to declare that how much percent the payout is, because the earning per share is 8, right? $8, and out of which they are only paying 50 cents. So how much is the payout ratio? And very simple. The second part is saying, suppose Rootland has 7 million shares outstanding. So right now there are 7 million shares outstanding. Borrowing from for the coming year is planned at 14 million. So they want to borrow money 14 millions from the market. Borrow, not equity, but borrowing. What are planned investment outlays? Assume a residual dividend policy. Uh, what target capital structure is implicit in these calculations? So we have to see what are planned investment outlay assuming a residual dividend policy. Now we see that because there is a retained earning, then retained earning is about out of 8.5 is paid out, and the remaining is a retained. So because this corporation has a retained earning and they are also borrowing, so we'll see that what is going to happen to their debt to equity ratio. So first of all, the question is required that we have to find out our payout ratio. So payout ratio. So how much is the dividend paid? It's a 0.50. And how much is the retained earning? How much is the earning, total earning? So that is going to be the payout ratio is 6.25. We're just paying out of the income 6.25%. The remaining 93.75 is as a retained earning. So we see here that is our payout ratio or payout. So now the B part is saying, I'm going to read once again. Suppose the Rootland has 7 million shares outstanding. Borrowing for the coming year is planned as 14 million. What are the planned investment outlay assuming a residual residential dividend policy? This is again a typo. Residual, so it should be a residual, not a residential, right? It's residual dividend policy. What target capital structure is implicit in these calculations? So we are under a residual dividend policy. The addition to retained earning, which is the equity portion of the planned outlays, is retained earning per share times the number of shares outstanding. So we see here that how much we are retaining. This is 7 million shares, and we are retaining 8 minus 0.50. So we are 56. 52, not 56. 52.50 million. This is a equity portion of our capital outlay. Equity portion of our capital outlays. Now, how much we are borrowing? We are borrowing 14 million, and equity is increasing by 52.50 million, right? Because if you calculate, we don't know exactly the total equity, but we calculated here that how much is the equity we are retaining. So we are calculated here that we are retaining 52.50 million, and 14 million we are borrowing. So we can say that the debt equity ratio in the new borrowing dividend by the new equity so is 0.267, or we can say that it's 26% is a debt, and the remaining portion 26 point or we can say that 27% is our debt, and 73% is our equity in our new project. So this is all I want to share with you from this chapter. This is a short chapter, having just discussing the dividend and different types of dividends and their policy regarding the dividend. So I hope you enjoyed, and this time I introduced some questions. The reason for this is that we want to discuss the chapters in total in full length, as well as we want to do some practice questions, so that that makes your understanding more clear, and raise and retain the ideas for a longer period of time. That's all for from my side. If you have a questions, if you have a concerns, you can send me an email, or you can raise the questions in the comment sections of the my YouTube channel.